In August 2024, the IRS and Treasury issued proposed regulations on the corporate alternative minimum tax, effective for tax years beginning in 2023. The regulations expand on guidance issued over the past few years, but they also introduce many new rules and concepts, a handful of which don't currently exist in book or tax systems. Under the novel bottom-up approach for determining a partner's distributive share, the partnership would calculate its AFSI first, which then flows up to each of the partners. This approach creates concern about information reporting between partnerships and their partners, and presents a case for reconsidering tiered structures and future investments. The regulations also create a hybrid record-keeping system that would require corporations to separately track and compute their CAMT earnings and CAMT basis, which will often differ from both book and tax basis. New rules for restructuring and M&A transactions add further complexity and new considerations for corporations, as these rules could create timing differences and double counting issues. Prior guidance can be relied on for tax years ending before the regulations were issued, but the actual proposed regulations are split between sections that can be relied on now and sections that can't be relied on until after final regulations are published. Regardless of size, all corporations are required to take some action each year to determine whether they're subject to CAMT. Unless a corporation certifies that it meets the safe harbor method by completing the new Question 29 in Schedule K, the corporation is required to complete and attach Form 4626 to its tax return. Many aspects of these proposed regulations add time, cost, and complexity to corporate compliance and decision-making. And although CAMT is only projected to increase tax liability for about 100 of the largest corporations, the administrative and compliance burden is proving to be much more far-reaching.